Right, good morning everyone and welcome to our fraud webinar. My name is Taryn Forsyth and I'm an associate in the Risk Advisory Services Department here at RSM. Fraud is a very real risk facing all businesses today. As the economy tightens, employees are under more and more financial pressure, creating the incentive to commit fraud. And as fraud increases, businesses can no longer afford to ignore the risks. Fraud and a company's approach to fraud is therefore complicated and complex, as it is not only the accounting and internal control aspect which must be considered, but also the human behavior element. Right, so in today's session, we will run through a few current fraud statistics globally, as well as those specific to South Africa. We will work through some examples of common types of internal fraud and discuss the various detection methods, as well as why fraud often goes undetected. We will then move on to the consequences that fraud can have on an entity, both financially and operationally, and provide a high-level overall approach to fraud. We will then conclude with some of the benefits of using a forensic accountant. Okay, so let's start with some of the general fraud statistics. Although fraud awareness is continually increasing, we are seeing a steady growth in fraud both globally as well as in South Africa. In a 2018 fraud survey performed by PwC, 49% of the companies surveyed globally stated that they had been impacted by economic crime. South Africa was almost 30% higher at a staggering 77%. The Association of Certified Fraud Examiners, known as the ACFE, issue a report annually on internal fraud. In the 2018 ACFE report, corruption is noted as the most common internal fraud scheme for sub-Saharan Africa. The report profiles the typical fraudster as being male between the ages of 36 to 46, holds a university degree, and is a first-time offender. The percentage of male perpetrators was over 70% from manager level up to owner or executive level. However, at employee level, males accounted for 58% of the fraud. These stats are likely more highly weighted towards men due to the gender mix at more senior levels. In the investigations which I have performed, I've seen fraud being perpetrated by both genders across all age ranges, from males in their early 20s to females in their early 60s. 85% of the perpetrators were identified to be first-time offenders. However, a first-time offender is determined as having not been previously terminated or punished. It therefore does not necessarily indicate that it was their first time committing fraud, but rather their first time being caught doing it. 19% of internal fraud was committed at owner or executive level, with 44% of the fraud being committed by employees. However, the value of the fraud committed at owner level was 6 times the value of that committed at employee level. So the more senior, the larger the value a fraudster is able to extract. Unsurprisingly, the top 3 sectors targeted were identified to be banking, manufacturing, and government, with corruption being the most common fraud scheme across all 3 industries. In terms of the average duration of a fraud scheme, it was determined to be 16 months. Cash on hand fraud lasted about a year, whereas payroll schemes were only uncovered after 30 months. 40% of the perpetrators worked within either the accounting, operation, or sales department of the organization. The average loss suffered by the organization was more than double where the employees worked in the accounting department when compared to those in operations and sales. By far, the largest detection method was through a tip, with 53% of the tips coming from employees within the organization. Okay, so the most common types of internal fraud are asset misappropriation, corruption, and financial statement fraud, or it can be a combination thereof. Let's start with asset misappropriation. So asset misappropriation relates to the theft or misuse of company assets, both cash and non-cash. Generally speaking, the use of physical cash in business is reducing. Skimming is an example of cash fraud, which is essentially stealing cash before it enters the company's records. Investigating fraud relating to physical cash is probably one of the most difficult types of fraud to investigate due to the lack of audit trail. But cash misappropriation does not relate only to physical cash. There are numerous methods of cash misappropriation. Unfortunately, we can't work through all of these in our session this morning, but I have selected 3 common schemes, being billing, payroll, and refunds. So billing schemes involves the payment of what appears to be a legitimate business expense, however, is for the personal gain of an employee or an associated third party. I can provide a practical example of a billing scheme fraud, which I investigated. So there was a financial manager who had renovations done at his house, but he got the service providers to issue the invoices in the company name for which he worked. The financial manager then processed these invoices as company repair and maintenance related expenses. He also created fictitious invoices for other personal expenses, such as his gardener, his children's school fees, and also family holidays, under the pretense of all being repair and maintenance related expenses. Through this billing scheme, he was able to defraud the company in excess of about 7 million rand over a period of 3 years. Another example of a billing scheme I investigated was an accounts payable clerk who manipulated legitimate supplier invoices. So she would take those supplier invoices and manually inflate the value of the invoice and amend the bank account details on the invoice to her own personal account. She would then receive these funds into her bank account and pay over the legitimate amount due to the supplier. The employee therefore benefited by the amount that the invoice was inflated by, with the fraud remaining undetected for an extended period, as the supplier was always paid on time and there was therefore no outstanding debt. A payroll scheme. So a payroll scheme involves theft of cash from the organization through the use of the payroll system. So there are many different ways in which payroll fraud can be committed. For example, inflating charge-out rates, employee rates, inflating hours, or through the use of ghost employees. I worked on a fraud matter where the HR manager updated dormant temp employee profiles with her own bank account and that of her boyfriend, as well as her friend. She would then upload hours worked against these profiles, and they would then receive monthly payouts as part of the payroll run. Through this payroll scheme, the HR manager defrauded the company of about 2 million rand over 18 months. Fraud may also be committed through refunds. So refunds can be fictitiously generated, or it could just be a legitimate refund which is diverted for an employee's own personal gain instead of being received by the intended party. But this often then necessitates the rolling of debtors to conceal the fraud. Performed an investigation where a newly appointed accounts receivable clerk had taken over from an ex-employee, and she was just unable to reconcile the debtors, identifying a gap of around 20 million rand. Through investigations, it was discovered that the previous accounts receivable clerk was generating fictitious refunds which were issued through the use of cash checks. The clerk would then deposit these into his own bank account, but then would have to cover up the fraud by rolling the debtors' accounts. The company ceased using checks in around the mid-2000s, but the clerk had to keep rolling the debtors for over a decade so that his fraud would not be exposed. In terms of non-cash asset misappropriation, this generally relates to theft of stock or other company assets, such as stealing of stock from a warehouse. But it can also relate to the misuse of company assets. For example, utilizing company equipment for a side business on weekends. The next method is corruption. So corruption is a word we really hear all too frequently in South Africa. Corruption involves an employee misusing their influence for their own benefit and/or that of associated parties. Two examples of corruption are conflict of interest and bribery. Some companies attempt to mitigate the risk of conflict of interest by requesting employees and potential service providers to complete a form which is commonly known as a declaration of conflict of interest form. However, this in itself is not necessarily effective control. As we all know, people can lie and not truthfully complete forms. If these forms, however, are completed, it is something which should really be updated and reviewed on a regular basis. There are also online tools available and companies which can assess relationships between individuals and entities and assist in identifying conflicts of interest. Kickbacks are a form of bribery where there is collusion between an employee and an external party. So examples can be the awarding of a tender for a fee or for a percentage of that tender value. Another example may be an employee approving an overstated invoice in exchange for a benefit. Just a few examples of corruption that I've seen. We did work where there was a senior manager who worked for a company which made use of contracting houses for contract labor. He arranged for one of these contracting companies to subcontract to a company which was actually owned by his wife. Contractors were then recruited through this company. There was a clear conflict of interest which was not declared and was also hidden through the use of the subcontracting arrangement. Through this arrangement, the manager and his wife benefited financially. Another example was where a facilities manager was approving invoices from a supplier where certain of the work was not performed at all and where certain items were significantly overstated when compared to other suppliers utilized by that company. The supplier and the facilities manager, it turns out, were actually neighbors, and it was identified that the manager had received kickbacks for approving these invoices. The last method that we'll talk about this morning is financial statement fraud. So this involves the manipulation or misrepresentation of a company's financial results. This can relate to both overstatement of revenue, profits, or assets, or maybe the understatement thereof, depending on the objective of the fraud. Overstatement of revenue through creating fictitious sales or early recognition of sales may be done in order to meet set targets and achieve incentives or bonuses. Targets may also be met by manipulating the timing of expenses to delay the recognition thereof, thereby increasing profit margins and enhancing the perceived performance of the company. Overstatement can also be done to create the impression of a high-performing business in an attempt to attract investors. But it is not only the risk of overstatement, there is also understatement. For example, a company may want to understate their revenue in order to pay lower income tax. One of the most topical examples of financial statement fraud in South Africa recently would be that of Steinhoff. So why do people commit fraud? On the slide, I've put up what is known as the fraud triangle. And the fraud triangle is the framework which explains the reasoning behind an employee's decision to commit fraud. All three elements of the fraud triangle must be present in order for fraud to occur. The three corners of the triangle are pressure, opportunity, and rationalization. So firstly, pressure is the motivation behind the perpetration of the fraud. It can be financial pressure, such as being able to pay one's debts, or to maintain a certain lifestyle, or to fund an addiction like gambling or drugs. It can also be pressure to perform at your work and meet specific targets. Opportunity is the means by which an employee is able to actually perpetrate that fraud through identifying a loophole or a weakness in the controls. Rationalization is the justification for that action. So things like, I'll do it just this once, or I'll pay it back as soon as I can. Maybe I'm only taking it to help a sick friend or relative. But the justification could also be a sense of entitlement. This company treats me really badly or underpays me, and I'm therefore just taking what's due to me. The reality is that all companies are at risk of fraud. it is not possible for a company to control all elements of the fraud triangle. Historically, companies have focused on reducing the risks relating to the opportunity aspect of the triangle through the implementation and improvements around internal controls. Although companies cannot control the human behavior element as opposed to the system weaknesses, there are measures which can be put in place around culture and ethics in an attempt to somewhat counteract these elements of pressure and rationalization. Even though all companies face fraud risk, they don't all necessarily face the same fraud risk. For example, a financial institution may have very low to no stock theft risks, whereas in manufacturing, this may very well be one of the most significant fraud risks facing the business. So this slide is extracted from the 2018 ACFE survey of the various fraud detection methods. From the graph, you'll be able to see an overwhelming 40% of fraud was detected through a tip. Tip-off lines and whistleblowing hotlines therefore play a vital role in fraud detection. I think it's specifically where senior levels of staff may be involved, because hotlines provide an anonymous and protected means by which an individual can express their concerns without fear of jeopardizing their job or their future career within the company. Then, significantly lower, the second and third detection methods at only 15 and 12% respectively was internal audit and management review. It is interesting to note that detection by accident is the fourth largest detection method. In the fraud investigations which I have performed, the vast majority really were initially detected through either a whistleblower or really by complete chance. In the payroll example I provided earlier, where the HR manager loaded her bank details into dormant employee profiles, the fraud was actually detected by an ex-employee who, when completing her tax return, noticed that she had an ILP file for the company, even though she hadn't even worked there during the tax period. She then queried that ILP file with the company, who, when they investigated the matter, then identified the fraud. In the example of the accounts receivable clerk who had cashed refunded checks and was rolling the debtors, he sadly committed suicide, and it was the accounts receivable clerk who took over his position who then identified the gap. He had been rolling those debtors for over a decade with no detection. So if he hadn't have passed away and had remained in his role, perhaps that fraud would have gone undetected for another 10 years. Why do frauds often go undetected? Collusion. Collusion really is a large contributor. Through collusion, there are more opportunities to commit fraud. Employees are able to bypass controls which are in place and conceal their fraud for longer. Audit materiality levels. So the perpetrators really become familiar with the auditors and the audit procedures that are performed, as well as the materiality levels that are set. They can then ensure that the fraud value that they commit kind of stays under the radar and remains undetected. A lack of or weak internal controls results in a deficiency in the company's ability to identify the inconsistencies or suspicious behaviors. Also, where there is a lack of segregation of duty. So for example, where the same person who loads the payments then also approves the release of those payments. It is very difficult to detect fraud that is well concealed or covered up, for example, through a complex web of journal entries or by rolling the debtors, such as my earlier example where the clerk rolled the debtors for over a decade. People who occupy senior positions are also able to explain away their actions. Junior employees are less likely to question the actions of their superiors or may be intimidated by senior employees. Fraudsters can often be territorial and do not like other people getting involved or assisting in their duties. There is also a common workplace attitude of, it's not my job, and if it doesn't affect me, well, then I'm just not going to get involved. In terms of consequences of fraud, obviously, firstly, there is the direct loss that's suffered by the company, being the value stolen by the perpetrator. There are then post-detection costs which could be involved, such as legal costs and investigative costs for investigating and quantifying the value of that fraud. There are also indirect financial losses which the company may suffer, such as insurance. So you can get insurance which may cover the business in instances of employee fraud, but insurance payouts and increased risk equals increased insurance premiums. Audit fees. Fraud results in higher audit risk, which results in increased audit procedures and therefore higher audit fees. Perhaps also fines and penalties. So for example, through the fraud scheme, the company may not have paid certain suppliers and therefore may be liable to pay fines and/or penalties. There are also tax consequences which may need to be assessed. In our payroll example, the company paid over PAYE for ex-employees who were no longer employed by the company. Where fictitious sales are created, this results in increased output VAT as well as increased income tax being paid. Fraud may also have a negative impact on a company's share price. Confidence and reputation. So confidence in the company and the reputation of the company can also be impacted and may result in other companies not wanting to do business or even be associated with that impacted company. It can also result in membership with certain associations being denied. Fraud also impacts the employee morale and motivation. Fraudsters are often well-liked and trusted individuals, and other employees often feel personally let down and may have viewed that fraudster as a close friend. Association with the company name may also be troubling and embarrassing for employees. And then, of course, there's plugging the hole. The company then needs to dedicate time and resources to ensure that that opportunity relating to that fraud risk as well as others are reduced. This could involve improving controls or creating new controls, investment in technology, as well as additional responsibilities for staff members, such as the requirements for independent reviews, duplicate sign-off, and additions of segregation of duty. I've put together a few thoughts on an overall approach to fraud risk as part of a fraud prevention and detection strategy. This is by no means meant to be an exhaustive list. But as tips on number one fraud detection method, hotline or whistleblowing installation and monitoring really is a key consideration for companies. A pre-loss fraud risk assessment, especially by a forensic accountant, will assist a business in identifying and addressing fraud risks in the business before a loss even occurs. When it comes to fraud risk assessments, there really is not a one-size-fits-all approach, but rather tailored to identify the risks unique and specific to that particular business. Independent management review, external and internal audits are all methods by which detection may also occur. Creating awareness and training around fraud and ethics. Creating a culture that takes a strong stance against employees who commit fraud may dissuade an employee from committing fraud. Then surprise audits. So external and internal audits are planned in advance and allows perpetrators to prepare responses and false documentation to explain away or conceal their fraud. By performing surprise audits, a company may catch the fraudster off guard and can also be used as a deterrent, with the fraudster knowing that they could potentially be audited at any time. Background checks and lifestyle audits are important when interviewing a potential recruit. However, ongoing checks on existing employees may also reveal a sudden or unexpected change in lifestyle. So what are the benefits of utilizing a forensic accountant? Forensic accountants can assist with both fraud detection, being investigative work after a fraud loss has occurred, or prevention to identify and address fraud risks. Forensic accountants bring a fresh and independent approach and perspective and may notice risks which management may have missed, as they are often too close to the daily details. They also have the necessary skills and expertise and know what to look for when performing investigations, as well as in performing pre-loss fraud assessments. The benefit of a forensic accountant can also often outweigh the cost by reducing potential future financial losses due to fraud. In performing their procedures, forensic accountants may identify areas for improved process efficiencies. As mentioned earlier, setting a strong stance against fraud may dissuade an employee from committing fraud. The use of a forensic accountant adds to that culture and perception. Okay, so that brings today's fraud webinar to an end. If you have any questions or if there's anything that you would like to discuss, I've put up my contact details as well as that of my colleagues, Brett Eaton. Please feel free to get in touch with either of us. I trust you have all found today's webinar beneficial. The webinar will be uploaded onto the RSM YouTube account later today. Thank you very much for your time today and have a good day. Goodbye.